This is our 50th episode. I want to reflect back on the last 49 episodes that we've done.
I think the one thing that I've learned in this space is that climate is not one industry. It's like hundreds of micro industries.
Yeah.
And it is extremely difficult to become an expert in all of those areas.
To me, I think the biggest learning is that climate is touching every industry.
Yes.
So if you were doing something in industrials, well, climate's touching that. If you were doing something in food, climate is touching that.
The whole thing about this podcast is not what does the planet need? It's how to build the solution correctly once you've decided you want to build something.
There has been a lot of propaganda from large companies that have made it seem like it's your fault. If you use plastic, if you don't recycle, it's your effing fault that the planet's getting effed up.
It's clear to me that companies do not know how to market.
Hey folks, welcome back to our 50th episode of Climb by VSC. We're here in studio with my co-host and partner, Vijay Chattha, the other general partner of VSC Ventures. We're gonna talk a little bit about the journey that we've been on with this show, launching it just after Labor Day last year. So we've been going for about 50 weeks, and I'm so excited for you to join us. This might be the first time you're seeing or hearing from us. Thank you for joining us, and let's climb. So Vijay, thank you for joining me here. You came all the way from California out here for Climate Week. Let's start with just a little bit of introduction on you for the listeners that maybe haven't gotten to know Vijay Chattha and VSC.
Sure. So quick background. I've been an entrepreneur as long as I could be one. Started at 16 with a little DJ business with a friend. We did bar mitzvahs and Indian weddings. And I got a first touch of like building something and trying to make some money. And it continued in college where I started getting involved in like putting on events and parties and promotions. We brought some record labels to the Penn campus, and I started my first company in college. And basically from that moment, my dad had mentioned one thing to me, which he said, don't get too comfortable as an entrepreneur because you'll never want to work for anyone again. And unfortunately, I got comfortable. And what I found in the world of Silicon Valley and technology, which was booming, and one of my best friends, Nahal, who brought me into the tech world, we started that company together. I realized that there was a big delta between some of the biggest change makers that are going to be brought into society and their ability to communicate clearly with their audiences. And so the idea of helping people that were very different in skill set to me was very appealing. And I fell into this idea of working in publicity, which I had never thought of, but it just so happens. That's what you do in life. You find some sort of niche and then you try to become valuable. So my core of who I am is like, how can I be helpful to other creative people in some way or capacity?
Yeah.
And if I could find some value or be valuable, then I would be happy inside.
So let's tease the VSC 20-year journey and how that turned into, somewhat self-servingly, you and I coming together to do VSC Ventures. So how did you become a climate investor?
So basically, I'd say the first thing is about when you're helping startups, you start to realize that it's not just about what you do, it's about that entire organization succeeding. And everything is starting from 0 to 1. And often for us, it's early. It's working with founders when they're sometimes 4-person companies, 2-person companies, all the way to companies with hundreds of people. And I always enjoyed the early stages. And what I started to realize was that the work we did with the founder was very similar to the work that the early stage VCs were doing. So I didn't see a lot of difference between what I was doing and what they were doing as it relates to just providing value. So, and what is the value? The value is recruiting, or is it sales, or is it publicity to drive all those other things, or fundraising? There's about 4 or 5 things that each founder needs at some point. And I realized that we were pretty good at one of those. So we started investing like little angel checks, my wife and I, into some of these companies. Sometimes we took equity for service, and it started to become very successful to the extent that I got the bug to basically see, what if we actually pull the reverse Andreessen? So instead of being a venture firm that had communications, could we be a communications firm that had venture?
Yeah.
And gratefully, we have 88 LPs that were friends and former founders that have been successful, who believe in us and believed in what we did for them, that they want us to do that for others. And that's how this all started. And, we got connected again through a trusted friend, and who I asked him, who is one person you're blown away by? Give me a recommendation. And it was you.
Yeah.
And we started with a project.
Yeah.
And then COVID hit. And then, things started hitting again during COVID.
Yeah.
And it gave me enough confidence to say, hey, let me jump out of my comfort zone and really go into venture in that regard.
Yeah.
And so it's a different business. It's a
Very
different
much so.
ball game. It has its own maturation process, which is completely different than publicity where you want instant gratification hits. Venture is the exact opposite.
And I'll share a little bit of my background for our listeners who are hearing from us for the first time, because most of the episodes they're going to hear from me, they're going to hear from you.
Yeah.
You know, I kind of became a climate investor accidentally. And one of the guests we're going to have on the show very soon is Frank Rieg, who's the founder of Revel. When I invested in them at my last fund, Launch Capital, I've been investing at seed stage for close to a decade at a couple other funds, worked in media strategy at places like the NFL before. And when we invested in Frank, you know, they weren't a climate company. They were trying to do shared micromobility in an urban setting and sort of changing the game from, you know, scooters like Bird and Lime to doing mopeds. And what that company has become now is a climate darling, electrifying the urban grid. And to me, I think the biggest learning from that is that climate is touching every industry.
Yes.
So if you were doing something in industrials, well, climate's touching that. If you were doing something in food, climate is touching that. And so the big unlock for me and kind of where I kind of got right with my like, is this really the world that I'm in right now? And it is,
Yeah.
is every industry that I was investing in over the last decade is now impacted by climate. So why run from it or try to avoid it when actually the underlying thing that we need to be resolving is climate tech and climate innovation and actually helping these companies scale. So that's how we got together. So we got together to raise this fund. We've raised a $21 million venture fund. We've invested in 17 companies now together.
Yep.
Helped some of them scale to their Series A. And you know what I wanted to do on this episode with you, Vij, today, and really make this a conversation, because I've been doing too many interviews. You know, this is our 50th episode. It's the first one that we're doing in studio. This is really, hopefully, the direction we're going to keep going with the show. I want to reflect back on the last 49 episodes that we've done.
Yeah.
Lessons we've learned, folks we've had on that just blew us away, stories that kind of stick with us and stay memorable, and really, I think, highlight how we are different a year later.
Yeah.
Right? So let's start with that. We've had on scientists, we've had on policymakers, mayors, a lot of investors, a lot of founders. Is there a particular category of guest that you really enjoyed either interviewing or listening to on the show?
Well, let me first answer the first question you asked that I didn't answer correctly, which is why climate for us.
Why climate? Yeah, let's talk about that.
Right. So just really quick for me, the wildfires. They hit Northern California. They hit the North Bay. My sister's house was burned down in Santa Rosa. Many people died in that neighborhood. We looked at the sky every morning. It was pink. It was orange. I'm looking at my kids and I'm saying, do I want to do investments in AI for accounting software? Or do I want to work on this problem literally outside my house? And what if we actually took the superpower of storytelling and the resources and capital and dedicate some of that to climate? And I think what we've realized in a year, to answer the second part of the question, is we're doing more of it. We're leaning more into this. It's just, I mean, look, every day you get to wake up and say, what's my why? This is the why.
Yeah.
If we can accelerate some of these solutions, then I will feel pretty happy when I'm done on this planet that like we took something of what we've learned and our skills that we've been educated on or we've been grateful enough to be able to do and applied it to something that actually matters. Support founders that are working on important problems. That's what we're doing. And part of this like podcast is learning how to support.
Mm-hmm.
The whole thing about this podcast is not what does the planet need? It's how to build the solution correctly once you've decided you want to build something and what to avoid so that you don't make a mistake of other companies. Because the stuff that we're building is hard and there's a lot of failure too.
Yeah.
Right. And so can we actually de-risk the next founder through our podcast? That would be the value I see that we're bringing.
So has it been mostly investors that you've talked to or founders that you kind of find yourself like really leaning into the conversation or really connecting with them?
I'd say there's two types of investors I've really liked. One is the clean tech 1.0 investor that dealt with a lot of bad outcomes initially, financially.
Yeah.
And those that have still stuck with it is the true OG climate investors. Andrew Beebe at Obvious, he was in Clean Tech 1.0. He's still in Clean Tech 2.0. He's seen a lot of scars. He's seen a lot of things work and many things fail. First of all, shout out to those folks that pioneered this investment structure. But what is that? Those people walked so that we can run.
Yeah.
Right? So shout out to those folks that are still in the game. There's many of those folks that have gone upstream. They're doing growth stage. They're doing other things.
Yeah.
And they figured out alternative capital financing. Very important that we had to have that first phase. The second type of investor is someone like, I'd say like Tom at One, who really sort of shed light on this idea that you can't be cost neutral with a new solution,
Mm-hmm.
and people will not pay a green premium. You basically need to get to 3x better margin on your solution, or he won't invest in it.
Wow.
And I think that was a good, simple, clear way to think about all these founders that are building. Are you assuming people are going to pay more for something that's better for the earth? Are you assuming that the same price is good enough? And Tom would say, same price is not good enough because it's going to take hundreds of millions of dollars for a big organization to refit their entire
Yep.
supply chain for this same price thing, which means they're losing money.
Yeah.
So I think that was a eye-opening early conversation that's impacted some of my thinking on
Yeah.
investing. So tell me, so on your side, where are you in your journey of understanding climate technology? 48 episodes in,
Yeah.
from where you started.
I think the biggest myth I had to dispel was this is a space that I need a PhD to access. That was actually my biggest apprehension around world saving. Oh, it's enzymes that break down plastic, and it's understanding deeply how energy gets sent around the grid, and it's understanding interesting levels, cell molecular level, how food and alternative proteins and beyond meat. And it is some of that, right? It is. And because climate tech is one very, very broad. But actually what I learned about this investing space is folks like me, folks that have been traditional software investors, actually have quite a bit to offer the companies in this space. There are some really, really great scientists and engineers that struggle with storytelling, content, like building a pitch deck that tells a concrete story that isn't just, here is technical jargon and scientific equations, but actually connects people to outcomes. There's a really great Steve Jobs quote that I find myself quoting more and more to people: sell outcomes, not features.
Yeah.
And he would repeat that all the time to his team because, folks would say it can hold 2,500 whatever. It's like, no, what is the outcome?
Right.
Your music wherever you want it.
Right.
Right. And if you connect with people at that level, ultimately it just gets you closer
Yeah.
to your customer. And so that was a big unlock for me doing sort of 49 episodes now, is the more investors that I talked to that said, the best founders in my portfolio do this. And I go, okay, so there's probably a lot of those founders that don't do this that we can actually help along the way. Great. I have a role to play as a climate investor. It took quite a few episodes to get there, but I'm actually very happy that I went on that journey.
Yeah, that's great. I think this other parts that I would see of those 50 episodes. One is that Climate 2.0 is still in its infancy to the extent that there is a lot of collaboration and non-gatekeeping of insights.
How so?
The people we have on are very open about what works and doesn't work. They're open to come on. They're open to talk about why they invest in things. They're open to share deals.
Mm-hmm.
So not, at the sort of 2020 hype zero interest rate world of, let's say, SaaS or other areas, there's a lot of sharp elbows as you get up the stack. I feel like maybe it's the market reset, or I think it's because people want to save the planet, that this is a fun, collaborative environment right now.
Yeah.
And it feels like being in university, or it feels like being in that first job at a company where everybody is excited and sharing ideas and sharing deals. I think that's fun. Like, I was part of that in mobile
Yeah.
in the early 2000s, and everybody was generally excited to learn from each other. And what was the most surprising is that direct competitors would sit down and talk about how to grow the pie in a way that you didn't see in like Wall Street or something before that, or maybe even Web 1, maybe that was the case, but we're there right now. This is the moment
Yeah.
where people are open-minded, they're sharing deals, they're introducing founders to each other. I don't see a lot of cutthroat competition, especially at the early stage. I guess
Yeah.
that's where we are.
Yeah.
But it makes me feel optimistic about why people are investing and why they're building. It's not just to make money. It is to make some money, of course. It's to actually make real progress in society.
Yeah.
It's always fun to be in a new market where there's still that level of like collaboration. It's just important to like take a moment and like appreciate the people that come on our show.
Yeah.
That don't need to come on. They don't need to give away their secrets. Tom doesn't need to tell us about his like margin strategy, but he does it because he wants more companies to succeed, I bet.
Yeah.
And I think that's cool.
Yeah. What is something, as you look back on the last year, that you believe now that you didn't believe a year ago as you've gone on this journey to climate investing?
I mean, it's clear to me that companies do not know how to market.
Hmm.
And maybe they will argue that they're not ready to market, but the more time I've spent with them, they're definitely ready to market.
By companies, you mean startups, not later
Startups.
stage companies. Yeah.
Startups are not they're not taking advantage of so much low-hanging fruit that's out there.
How so?
Simple website, LinkedIn marketing, so cheap. I mean, you could just literally find these individual people that will buy your product that you'd have to go to a trade show 5 years ago to find. Video. Either they're super cool and need to be turned into a video, or they're super complex and need a video to explain it. But these things are like marketing 101 now. It's
Yeah.
just website, video, LinkedIn. Like very few are doing it. Very few of the ones that are making $1 million in revenue are doing it.
Yeah.
And so I feel like this is the next untapped market, is get these founders to see the quick wins that can be created, because everything's about revenue right now. So there's nothing better than the customer funding your company.
Yeah.
Right? And it takes a long time for them to get adopted into the system. Therefore, the longer you wait to do your marketing, the longer you'll wait to get the revenue. So that's one of my learnings. How about yours?
The thing I used to believe was that this is less about investing. As a consumer, my choices, I thought it played a much bigger impact, right? If I'm choosing better options for the climate, if I'm, choosing a place that does plastic straws or that does compostable cups or does this kind of stuff, I am making a difference. And the more folks that I've talked to on the show, in a way it's freeing because there has been a lot of, and I don't say PR, but propaganda from large companies that have made it seem like it's your fault. If
Yep.
you use plastic, if you don't recycle, if you take a paper bag from Trader Joe's and you don't bring your own recyclable bag, it's your effing fault that the planet's getting effed up. And the folks that are sending this propaganda out are oil companies, chemical companies, plastic companies.
The polluters.
They're polluters. And it has been very, very profitable for them to point the finger back at consumers. And I think that just adds to climate anxiety. And I will tell you that doing this show, my climate anxiety has come down.
Yeah.
Not just because I'm hearing from people that are sharing the solutions, but also it's like that scene from Good Will Hunting where he's like, it's not your fault. It's not your fault, Jay. It's not our fault.
Yeah.
We were not the folks pushing through, delegislation in the 1980s that allowed these companies to pollute. And it's not our fault right now. If you go have almond milk latte in a plastic cup, it's the fault of the company creating that plastic cup. And it's the fault of the market that hasn't created a better alternative
Yep.
for those plastic cups. And I think recognizing that, I used to believe that there was a lot more that I could do as a consumer. I am now confident that there's a lot more that I can do as an investor.
Yep.
And I think that's been the biggest evolution, and kind of like feels like a little bit of a burden off. I still try to make better choices in what I eat and what I buy and the things we choose. Take a green premium when my wallet can afford it. But it kind of refocused me on like, where should my energy be really going?
Yeah.
And it's actually to finding a better alternative to that cup, not to feeling bad that I'm using that cup.
Makes sense.
Yeah.
I'd say that there's probably one company that's figured this out, which is Tesla.
Yeah.
Which is that they really didn't spend a lot of time focusing on the planet. They focus on a superior product.
Yeah.
It happens to not need gasoline, but the Tesla is just a superior car than anything at that price point. That's gasoline.
Mm-hmm.
It's just a better product.
Mm-hmm.
So founders can learn from this point of what Elon did is just make a better product, period. And the green thing should be an add-on. It's just like a nice to have that it's green. It should be a better product. The burger should taste better, right? Or else it's not going to get to the next level. And so that is the challenge for tomorrow's founders, are that assume that the green premium is zero.
Yeah.
And people expect it to be a green premium if it's a new entrant, but the product has to be better than the existing product or it's not going to work.
Yeah. Yeah, that's spot on. What guest surprised you the most or kind of left you thinking, questioning things after your conversation with them?
Well, I liked having Janelle on, who is the mayor of Sausalito, because it's nice to see a politician who's effectively like an entrepreneur. And she, in her podcast, said, I'm inviting more ocean-centric startups to partner with the government.
Hmm.
Come find me, come like collaborate with me. The second thing she said is, I think she's running for lieutenant governor,
Oh, is
actually.
she? Wow.
And her campaign strategy was, I want to go play basketball on like the public courts between the top of California and the South. And I want to spend time with people. I just want to play sports with them as my way to get to know them. I was like, that's refreshing, right? She's an athlete too, but I loved it. And I'm like, I like everything about this concept of like connect with people where they are in their environments, find a way to share some sort of common bond. And secondly, like, let's make a city an open, like make them playgrounds for entrepreneurship to participate. And I think more cities that think that way are going to do great, and they're going to foster these little environments. And so I liked her. It was just, we didn't have a lot of politicians on.
Yeah.
And when you're a mayor of a small town, you don't have to be as like conservative in your talking points.
Yeah.
So it's nice to have that fresh perspective.
Yeah, I'm trying to think about which guests have specifically left me kind of thinking or questioning. I would say we've done a couple of episodes around the IRA. And the one that's like sticking out of my mind, I don't know if he was the first one to talk about it with me, but Vaughn Blake from Blue Bear Capital. We were talking, we do this segment on the show sometimes called Hyper Hopeful, and I'm talking to him about the IRA. And he was the first person willing to go on record and say, yeah, I think the IRA is kind of hypey when it comes to startups.
Mm.
Because if you actually dig in and look at where the money is going, it's going to infrastructure projects, wind, solar, geothermal, right? If you're a startup today and you're putting in your pitch deck that the IRA is a massive tailwind for us, like you are being disingenuous, is what I would say,
Mm.
right? What I would love to see from a company is, hey, we are going to be a great business. Here's what we think our unit economics are going to be. Like, all this stuff is great. And oh, by the way, if the IRA money trickles down our way, then look how much faster we can grow.
Mhm.
But you cannot be a business just because there has been massive subsidies coming in, right? And
Right.
I think Vaughn was the first person pointed out. We've had some other folks on the show that have talked about the IRA. It kind of left me thinking and questioning a little bit of like my own belief about, hey, we're celebrating this great win, right? And it is a great win. And we're worried about when it comes to election season how much of that could be taken away if there's an administration change. But as investors, especially at the early stage, like, let's not kid ourselves. Like, this is not why a company should exist or why a company should do well just because there are federal dollars that are coming out to it.
Yeah. I agree with you on that point, and it's not the iPhone necessarily moment for every company.
Yeah.
But I would say that the one thing I've learned a lot in this last year is the role of government in this industry
Okay.
is big.
Yeah.
They are the funders, they are the buyers, sometimes they're the sellers. They will be part of any company's trajectory. Look at Tesla.
Mhm.
They were bailed out by Obama, right? They survived on subsidies for years. They still get tax credits in states. They moved their gigafactories to other places for even better incentives.
Yeah.
Government played a huge role in this company succeeding so far. And it's almost like defense technology as a vertical. This industry needs government. Without the government, it's not going to succeed.
That is so antithesis to the last 10, 12 years of Silicon Valley. When you listen to
Yes.
Travis Kalanick or early days of Airbnb, and again, not comparing those two founders, but their approach was kind of try and stop us, right? And that I sense you're also feeling is like not the way it's going to go in this industry.
I read The Fixer,
Okay.
which is a great book.
Yeah.
With Tusk.
Yeah.
And he talked about, let's talk about Airbnb and,
Okay.
and Uber for a second. Uber needed a lot of lobbying strength in many cities to survive. Without lobbying, they'd be dead.
Yeah.
And frankly, now that they're publicly traded, they don't have as much VC dollars for lobbying. When you go to an airport now, you're going to have to go a couple miles to get to that Uber stop in LAX.
Yeah.
You're going to have to go to a different parking structure at SFO to find the Uber. Some places you have to get on a bus.
Mm-hmm.
Dude, without that lobbying money, look what's happened to these places.
Yeah.
Airbnb in New York.
Yeah.
Okay. Hey, is it a coincidence that the same week that they canceled these Airbnbs, the hotel prices are $600?
Yeah. Yeah.
Hawaii, banning short-term rentals. Government plays a big role in those companies. And they're getting screwed right now because they've lost all that lobbying money that they had from the hightail funding environments of pre-IPO.
Yeah.
I would be very worried about all those companies because every year that goes by, it seems like the hotels are fighting back, right? And they're blaming it on like how affordability, housing, all this stuff. But why is it that the hotel price goes up in exactly the same week as the Airbnbs are
Of
gone?
course.
I mean, come
It's
on.
correlated. Yeah.
It's correlated. And how come Uber and Lyft are basically like stepchilds at most airports where there's just stop basically paying off the airports? I think we were living in a dream world where Silicon Valley was moving fast and breaking things. What they were really doing was moving fast, breaking things, and paying off a lot of people.
And that's all gone now.
And then when the checks start drying up,
yeah.
the Uber's pickup starts moving further out.
Now,
we need the government.
Well, and I think the challenge also is that where a lot of the companies we're investing in are interfacing, government is no more than 2 degrees of separation away, right?
Yeah.
If you're dealing with a power or energy company, guess what? They have to deal with regulation because of zoning or whatnot. So you may not think my customer is the government or my customer is a government-backed entity, but they are interfacing with those issues. And therefore, your ability to implement, get adoption, move fast, hopefully not break things, is impacted by that local regulation.
Yes. I would say that the biggest learning I've had now is that the role of federal and state governments over the next 10 years will basically make or break our society in terms of startups. Where were all the AI people last week? They were in Washington, D.C.
Yeah.
Right? That's software. That's not deep tech. Why do you think these chips companies are all blowing up right now? Maybe the CHIPS Act? Maybe because America has to make its own chips now? Right? So we're going to go to a place where I think there's going to be deglobalization.
Yeah.
Which means we're not going to rely on China for certain things or Taiwan for certain things or Ukraine for certain things. We don't know if our supply chain is going to get messed. We're going to have to make things here. We're going to have to make things we're going to have to become better friends with Mexico and Canada. And I think that the companies that understand that now are going to be very well positioned. And also, how do you make it where it's not political between the GOP and the Dems and make it a good fit for everybody, right? I think you find a fair number of Republicans and Democrats will fund defense industry in this country forever.
Yeah.
Right? They keep giving more money to it. If we start to look at innovation as actually a defense against other countries, it's going to get funded.
Yeah.
If you call it save the planet stuff, you'll get 50% of the vote.
Mm-hmm. We've talked to a couple founders on the show. We've also invested in quite a few founders. As you've been on this journey, how has your process for doing diligence and evaluating these founders changed? Because I have some specific things that I do differently now, but I want to start with you. What's changed for you?
I'd say the first thing is I like having a partner, right? I think it's good to have somebody else come into a diligence process that is not emotionally connected in some way to the first pitch or the founder. I mean, that's kind of why I don't do YC Demo Day. Some of the best advice we got from some of the other funds we love is, you know what, go back 2 months later and look at that deal. Don't get caught up in the moment.
Yeah.
And so as a storyteller, I get caught up in the moment a lot. It's nice to have a partner who's like, hey, I know you're excited, but blank, blank, blank. In the same way,
I feel like a lot of our calls start that way, by the way, which is, hey, this sounds really exciting. Have we thought about, blank?
Yes. So having a partnership is great because you can really think about it's the two of us we always try to find the devil's advocate in things, and that's fun. Maybe that's our style. That's I think the big thing I've learned. The first thing, the second thing I would learn is it does take a village to build a great company in terms of in sort of a cap table, and I've felt this way now for a decade. But the best investments that I've made are ones where I felt that the lead investors and the board were hands-on and were creative. They were not only financially motivated, they were either previously entrepreneurs or they were very excited about the nuances of the company to play a role or provide feedback. And as we look at these companies now, I look at who are the investors in the cap table? Are these people I'm going to also want to spend time with for the next decade? And what's their motivation? And what's their quality control?
Yeah.
What's their business model?
Yeah.
Are they spray and pray? Are they, this is the 2 deals I'm doing this year? Are they, hey, we already have like a mega unicorn in this fund, so I'm not gonna just have some fun with these investments.
Mhm.
All that investor cap table psychology is important. There needs to be an AI for that.
You don't have to look at AI for that, man. You look at their fund size.
Yeah.
I'll jump in on that, right?
Yeah.
So there's two things I think that I do differently now. So one, let's riff off of what you were just talking about. I think for a fund of our size, at a $21 million fund, there is probably a cap on fund size that we can collaborate with. Or we have to understand the incentives of the partner inside of a larger fund and kind of what they think success looks like.
Right.
I think that's the biggest thing. And a lot of founders miss this because they go for brand names and they think if I get XYZ brand fund as my investor, I am going to do well. It's going to unlock opportunities for me. Customers are going to, flow. And ultimately, that is all great when it's 2021 and the money's flowing. And when it comes to 2023, and you go back to that same investor, and it turns out that they were a billion-dollar fund that was writing $2 to $3 million kind of option bets, and you thought that you were the main, you realized that you were the side piece, like that becomes a really challenging moment.
Yeah.
Not just for you as a founder, but for the investors on the rest of the investors on the cap table.
Yep.
And I won't name names. I've had issues with other companies in my past career, like past funds, where this has happened.
Yeah.
Where you think, oh, this board partner, this lead is ride or die.
Yeah.
And it turns out that they're not. It was just an option bet. So you don't actually have to look at AI or incentives or whatever. You, I think, just have to look at the fund size.
Yeah.
And you have to look at the partner and understand how many boards are they on? How involved are they with the company? Are they a company builder? Do they come from that background? And doing that diligence, where especially when we look at co-investors, we've been in this ecosystem long enough, asking people that have co-invested with that person. How often do you check in with them? How often do they send you deals? How good are those deals? I think every time we let a new co-investor into like our community, so to speak, or our group, I think we do a good job vetting them. We understand why they're there.
Yeah.
I don't know if a lot of folks do that. So that's one.
Mm-hmm.
The second thing I'll say, and this is again like caution for founders kind of thing, right? Round names mean nothing. Pre-seed, seed, Series A, right? Like these have changed so much. When you guys worked with Poshmark, they did a Series A. It was $3 million. Today, that's called a pre-seed. Ultimately, what do those stages mean? And what is the stage that we invest at, right? Pre-seed is, can I build it? The thing that I believe my customers need, can I build it? Seed stage to me, where we really come in, does the customer want it? Will they buy it?
Mm-hmm.
And I think Series A is, are there enough customers for me to really make a $1 billion business out of it? And what I have learned is, don't worry about the fund name or are they pre-seed, are they seed, are they Series A? Find the folks that back companies at your stage.
Yeah.
Are you at the can I build it stage? Okay, you probably need a pre-seed fund. Are you at the will my customer buy this phase? Okay, you probably need a seed fund. And if you're at the wow, I have customers and they're buying it and I need to scale and I need money, okay, you're probably at the Series A stage.
Yeah.
I think I have now honed in over time and not gotten so caught up on round names and even round sizes, and really just dig in by talking to the customer. You say, great. Every one of the last, I'd say 6 or 7 out of 17 deals that we've done, we have had multiple customer conversations, both existing and prospective. And I think it just makes us so much smarter. And it sometimes leads to us passing on deals because the signal there isn't strong enough, but we like the founder enough to say, okay, when that customer signal becomes stronger, count us in. We're here.
And that's part of the function of a slower economy where we can take the time to do it compared to the last 5 years where there were deals sent around where the deadline was within a week. In or out type bullshit, which people could get away with back then, which is fine.
That's awful, by the way. If we're going to be in a deal, we did a seed deal in Glacier. We're going to be in that cap table for the better part of a decade.
That's right.
We're going to be in there longer than an average American marriage. Like, how are you going to get married in a week?
That's right.
And like expect there to be, I don't know.
Only in India. No, I'm just kidding. No, you're right. And so just 2 other thoughts on this whole.
Sure.
Like what should the founder, who should they have on their cap table, right? So the first was that there's some great investors whose funds are smaller than 50 million.
Yeah.
And if I'm a founder in climate, I want money from them. And maybe I want money from 4 or 5 of those funds. But I think what I would want now is I'd want 4 of those sub $50 million funds investing in my seed.
Yeah.
And I think that's a dream team because you're finding now that there's superpowers of specific areas. And when you're that small, you need to succeed with every company. So that's like the first thing I'd say. The second thing I'd say is if you want to get to after the A and the B, especially in like deep tech now, it's important to find an investor who is going to be patient and not freaked out by the market. We don't talk enough about that VC too, which is one that's seen so much that they actually provide like calmness to the founder to like, hey, just keep building.
Yeah.
Things will turn, right? Like we've seen a lot to know that you shouldn't just be so antsy.
Yeah.
So there's 2 types of energy. The early stage where you want I call it the cardiac cap table. You want everyone to be working for you, doing things, closing deals. Who do you know? Here's a spreadsheet. But then at the next stage up or 2, you want someone who's like with a cool hand. Like, hey, I know that just happened. Hey, that crisis just occurred. Hey, that machine broke down and had an issue. We'll fix, it'll be fine. Just what's your plan? And I support you. So that's the most interesting insight I got last week, Jay, talking to a founder I was like, who's your dream Series A investor? They said somebody with like a chill sensibility and patience to see the long-term picture here.
Yeah.
And I was like, man, I have not heard that in a while, right? We've heard about value add services and brand and closing deals, but it was interesting to hear from a second-time founder, not a first, that they want someone who's patient and chill. I was like, wow, that's nice to know.
Yeah.
And that's also nice to know how the companies evolve, what they need, what is the new energy that should come in at certain times. It's not the same energy with just bigger funds.
Yeah.
It's different energy.
Yeah.
So that was a new learning.
I think that a recent new learning, kind of building off of what you're talking about second-time founders and first-time founders, it's a question that I've actually asked quite a bit more recently, especially when I talk to guys like Leo or Susan from Eclipse or, the folks at G2VP, billion-dollar funds. John Doerr initially started G2VP inside of Kleiner Perkins. And I always ask, what do you see second-time founders doing differently that first-time founders can learn from? And I get a wide array of answers. The most frustrating part is everybody says, it's just a feeling. Like it's just a understanding. It's just the muscle memory of doing certain things faster or not freaking out about certain things. But I would say the most important answer that I've gotten is communicating better. Second-time founders, often they communicate better. They don't communicate more, they communicate better. And that was, I think, a really interesting learning, which is knowing how to lean on your community. You talked about building a cap table of these 4 or 5 investors. We read those quarterly updates.
Yep.
We read those monthly updates. If you send 2 monthly updates in the 3rd month or the 4th month, you miss it. Okay, like that's already a red flag, right? Yeah. And I keep hearing the best founders lean into the fact that they've got these folks around them. Often it's second-time founders who understand that like my cap table isn't just some money that's going to be silent and kind of, go away and let me go build things. I think we personally also like the founders that say, let me bring you in. Let me help you understand. Let me read you in. Yeah. And it doesn't mean that I have to hit you up every week or every month. Even if it's just every quarter, you're consistent. You have asks. You celebrate wins.
Yep.
You share challenges. And you lean on this network of folks around you to actually help you through those challenges.
Let's just discuss that. I've been a big proponent of second-time, third-time founders.
Yeah.
There's certain funds that we work with that only bet on second-time founders, or they only bet on someone who's been in their business, that particular industry for like 15 years. Their average founder age is over the age of 35.
Yeah.
Right?
Funny, Lior at Eclipse said the exact same thing. He said, now the folks I'm backing built a software company, 7-8 years ago. Now they're in their 30s and 40s, and now they're building a climate or industrial automation company.
Yeah.
It's not what you imagine. It's not the guys in hoodies.
It's not the guys in hoodies. And, so that's a big myth.
Yeah.
I'd say. What I've also think is interesting is there needs to be more standardization of investor letters. Like we know, I have one angel deal. I always forward you the guy's investment memo. I'm like, this dude should be making investment memos as a service. That should be his business because it's so damn good. It's so clear. And honestly, I'm just like, I'm ready to back your next company, man. If
Yeah.
this thing works, good. I'm an investor. But the next one, I'm backing too because you get it.
Yeah.
And more like, I guess a lot of founders don't have good news all the time. That's part of it. And they probably don't want to
But I think as investors, we shouldn't put the expectation that that update is about good news all the time.
Correct.
Right? Now,
That's right.
It may be that you feel like, oh, if I send this, I'm going to get some angry emails and angry letters. But actually, I would tell any founder listening, if you don't send it, you're more likely to get angry emails and angry letters.
That's right.
Because folks being like, hey, I gave you money 6 months ago. I haven't heard from you since.
Yeah.
But if you reach out and say, here are the challenges that I'm facing, and you position them as, here are challenges to my business. Can you help me? You are much more likely to get that help and much less likely to get investors who are like, well, I don't know what's going on with your business.
Yeah.
I'm unhappy.
I agree with you. And I think that it's short-sighted because founders will need to go back to capital sources for the rest of their career.
Yes.
Even when they're super rich and don't want to use their money, they're still going to want partnerships.
Yeah.
And I often sometimes I do look at a founder and say, wow, you had a great exit. Why is the VCs and the new one different? Makes me wonder, right?
Yeah.
Is that a marriage that went wrong? Right. And so those are little micro details that if you see the same investors backing the same founders 6 times over, that's probably a good founder.
That's a really good sign.
Yeah.
Yeah. So we'll close on a couple of things. So you've interviewed some founders on our show. You talked about one, Glacier, earlier on.
Yeah.
How has that experience and approach of meeting him, having him on the show, meeting him in person, made you think about kind of the right way to build, founder relationships before we make an investment?
The Glacier is an interesting one because we both got exposed to the company at the same time at 2 different places.
Yeah.
You heard about it through in your network.
Yeah.
I went to Near Future event. Shout out to Zem for an amazing event. I watched the video and I was like, that's amazing. That's robots recycling and automatically finding things using computer vision. Love that. Like I don't need a science degree. I get this.
Yeah.
We had Arib on the show.
Yeah.
He explained a great founder journey from coming from software, Web 2, Meta, to realizing he wanted to focus on these bigger problems. Then the podcast was great. He appreciated the clips. He invited us into the round, right? On top of that, I was able to go to Recology SF, the huge recycling place. And man, it takes a lot to leave Marin to go to a basically garbage dump. Went there. You're in garbage, man. You're in recycling. And to walk in there and first of all, seed stage companies that have enterprise customers that allow you to just walk in is almost non-existent.
Yeah.
Right?
Yeah.
A lot of these things are in like pilots and you don't even know where these are and if they're still running.
Yeah.
There's a lot of cloudiness to that. So going to the place, seeing the Glacier devices working in real time with, not needing as many people on there, then also looking across and seeing the bigger machines from some other competitors, they're just not working. They're not running. That's diligence. That's old school, pre-ZERP diligence.
Pre-ZERP.
And I was lucky it's in San Francisco. I was there.
Yes,
And you've got stuff here. You go to something's place here.
Yeah.
It's important to go in person and see stuff.
Yeah.
And that Zooming is great for a lot of stuff. But now we've returned to like having to, if in our world, you have to touch and feel the product again.
Well, so often the stuff that you and I are looking at, I think, has a hardware component, right? And I'll fundamentally like spell this out. The reason we get excited about it, one is there are so many software funds and all those deals are getting bid up and getting expensive. And yet venture still hasn't figured out a right way to do hardware. And here we are saying, okay, we think we can actually find the right companies in that space at that inflection point I talked about, right? I know how to build it. I can sell it to my customer. Great. The other thing is we come from a world of communications and media strategy and content, and these are very visual products.
Yep.
So give me a Glacier recycling robot every single day of the week as compared to a reinsurance platform. How the hell do you make a video about a reinsurance platform? Well, you can send a camera crew to Recology and show the robot in action, and it lets other customers kind of build trust. It's okay.
Right.
I see this thing. It's not hypothetical. It's actually real. And so I think that's the other angle of like, yeah, you have to do the diligence in person. It's kind of counterintuitive post-COVID. Everybody was like, yeah, I'm writing $50 million checks after meeting a founder on Zoom. Yeah, now we write a $500K check and we go out there and we spend time, face to face with the founder. I think it makes a huge difference.
It does. And I think that's fun. And it's not a correlation that the most newsworthy stuff is the best investment. Maybe you could argue the opposite. The least newsworthy stuff is sometimes the biggest investment.
Wait, so that's ironic, right? Like we are PR and content people at this stage. Like, why lean towards the non-newsworthy things?
I'm just saying there's two ways to make money.
Oh, okay.
You could invest in Snowflake, which is really not that newsworthy
Yeah.
until they're super successful and every story is about how much money they make.
Yeah.
But most people couldn't describe what they do.
Yeah.
Or you could invest in Tesla,
Yeah.
right? Where everybody can understand the car. Maybe they don't understand the valuation, but they understand what the thing is.
Yeah.
And so, yeah, we're going to dedicate our life to things that have a more visual storytelling component, because if we do pick the right ones, they could explode.
Yeah.
They could be some of the biggest
Yeah.
companies in our generation. The two biggest companies in America are Apple and Tesla. They're hardware.
Yeah. Yeah.
So there is optimism. We don't need more VCs to join into this world.
I know. Please stay
So
away.
we don't need to sell it.
Stick with software and let Vijay and I do what we're doing.
Yeah.
You know.
We need more founders, right? And we as Susan, who came on today, said, we need more adoption by corporations. So you're seeing robotics companies raise at up rounds right
Yeah.
now in this market. You're seeing companies like Amazon and Walmart adopting a lot of retail technology and robotics now.
Yeah.
And we're seeing what was a shock to people, which is that a lot of people don't want to work in jobs that it's a lot of it is just sort of the option to do other jobs in this world than the ones that now robotics can do.
Yeah.
And there was a fear in 2016 that the robots were taking the jobs.
Yeah.
There's fear maybe that AI is doing it, but not robots anymore.
Yeah.
Nobody's scared of a robot taking their job anymore. They don't want those jobs.
Yeah.
And so that's also part of understanding how PR and hype works. You shouldn't also get too scared about anything that comes out, because generally things are not as scary as they seem, and they're usually not as great as they seem. That's the other thing,
Yeah.
right? So we're like, the longer you're in this business, the more you realize that things are kind of in the middle.
Yeah.
And it's easy to get scared. Where everyone was scared about ChatGPT. Now, like the accuracy is down. Everyone's
Right.
going to worry it's going to end education. It won't. Teachers are using it.
Yeah.
So it's like the older you get, the
All
more
in perspective.
all in perspective. Everything's kind of in the middle. You can make money knowing that things aren't as bad as they are, and you can make money knowing things aren't as good as they are.
Yeah.
Right?
So I'll close on two questions. So the one, about optimism, we ask every guest. So I want to ask you, and I'd love to chat about it too. Before we do that, we fundamentally like to look at trends and big opportunities. From everything that you've heard on the show, from the last, couple of years of looking at these companies, what are sort of big trends and opportunities that you're excited about, that you're tracking, you're following, that you think are going to be opportunities for us to do deals as an investor?
I mean, I think we have to look at the problems that we're facing in this world and say, what are the biggest problems, and are there enough people and resources trying to tackle them? I think the one thing that I've learned in this space is that climate is not one industry.
Mm,
It's like hundreds of micro industries,
yeah.
and it is extremely difficult to become an expert in all of those areas. And even if you go into one rabbit hole like water, there's water funds.
Yeah.
There's people that have learned what doesn't work and does work. You want to go to another area? Go to solar. You could spend decades looking at different film that could go and do solar at a different pace. And so it's almost like the more I learn, the less I know, for sure, in this space. So the opportunities are everywhere,
Mm,
right? I think the question will be, how will these things get adopted, and who's paying for them?
yeah.
Right? And
Yeah.
who finds enough of a need to switch over because of the superiority of the thing? I think that's the thing. If we're going to, climate technology has to be a superior experience for the end customer always, or it won't work. And that's why the subsidies are not going to help in the long
Yeah.
term, right? They're
Yeah.
just there to kickstart.
Yeah.
On your side, like what gives you optimism, at this stage? And what gives you confusion also? Like,
Mm.
is there anything that's like making you, is it all optimism 49 episodes in?
No, I think there's a fair bit of, I said, my climate anxiety is reduced. It hasn't gone away completely. I think the challenge for me is the pace of adoption, not just as an investor, but as a person on this planet. As we welcomed our first child, my wife and I. Now he's real. He's not hypothetical. I'm not talking about, well, my future children are going to inherit this planet. I have a child who's going to inherit this planet. And
Yeah.
so that anxiety always comes from the scale of this problem. not just capping emissions now across all these legacy industries, but also reducing the impact of what we've already been doing since, really the last 60 years, kind of the most aggressively, but even sort of before that. So I think what confuses me is like, is all of the stuff that we're looking at just incremental? And yes, it's a great like business opportunity because these industries are modernizing, concrete, aluminum, steel. They're looking at a lot of opportunities. There's going to be customer adoption there. Is it enough to actually make a dent? Or, are we going to have a really successful fund, but ultimately look back and say, man, we barely made a dent in the problem. So I think that's where the confusion is, which is like the scale of the problem, the excitement that's around it. Are we just patting ourselves on the back and feeling really good, or are we actually making a difference? I don't have that answer yet. I'm still on that journey, and let's check in 50 episodes from now, and maybe I'll have a better answer for you. But to leave on a little bit more of a positive note, I think what keeps me excited is actually the two trends that we started with this conversation, work and world saving. They're converging. They are converging very actively. It is very rare for me to meet a company that is building in a legacy industry that isn't also talking about capturing emissions, capping emissions, reducing issues in the supply chain, issues in the production process, in the feedstock, whatever. It is commonplace to have that conversation. Yep. And so if you are a founder that is building in those industries and you're not having that conversation, your peers are already there. It's time to catch up. But that excites me because now it means that there's a lot more folks that are not, quote, climate investors that are still seeing the opportunity. And if we want to talk about why, we can say it. It's these IRA tax credits typically benefit the incumbents, right? Those are the folks that are better situated to actually absorb the benefit from that. But in order to absorb the benefit, they have to change fundamental things about their production process. And to do that, they probably have to look at startups and early stage technologies that are there, right? We're going to change how things happen on your conveyor belt or your production line. We're going to change how we pick and pack food so that you're not using high emissions transportation or packing properties. That really excites me. There are multiple billion-dollar businesses that are going to be built just helping these legacy industries decarbonize.
Yep.
And like that's actually happening and that's exciting. Is it happening fast enough? Is it going to make a big enough difference fast enough for like Avir when he's, 30 years from now being like, I heard you had a climate fund. Did you do anything with it? I don't know. I don't know if it's going to happen fast enough. And that still keeps me up at night a little bit.
Yeah. Well, two things that need to happen, I think, just to reflect forward a year, right?
Yeah.
If we look forward for the next year, two things that worry me. One would be corporations abandoning their ESG goals.
Yeah.
Which always happens in a recession. People make big promises around a lot of things that are not core to profit. And then interest rates go up or things reset or recession and people drop those things quietly or loudly.
We saw that with racial equity, right? All these goals around, post Black Lives Matter and we're going to invest in this. And then the market changes and nobody's really talking about those investments anymore.
That's right.
Yeah.
So that is a big issue because if they don't keep these goals, they're not going to mandate the adoption. So that's concern number one. Concern number two is the Republicans win and they dismantle the IRA.
Yeah.
Right. And generally because of the fact that it was Biden's thing, right? Not because it's not bringing jobs to their areas, but because they need to just dismantle. That's going to be terrible for this country. And the country is leading the world right now. So if we don't get this right, other countries are not going to adopt these solutions. And if we don't keep these things in order, it's going to be hard for the best students that come out of college and university to think this is a good industry to focus on versus going into something else that's just purely instantly lucrative.
Yeah.
Right. And so I think what's going to happen in the next 12 months is a lot of climate VCs and founders are basically going to be doing a lot of political action work, which is going to take them away from maybe building a little bit and selling and fundraising to preserve their own survival. And we're not there yet, man, but the clock just flips January 1st,
Yeah.
and these people start getting out in their primaries. And that last election was decided by courts, and we still had like 70 million votes on each side.
Yeah.
I think we have a lot of work to do ahead, and that'll be another skill, which is how do we mobilize again, like we did 4 years ago. And that IRA, that was 30 years in the making.
Yeah.
So if that thing gets dismantled, then we've got bigger problems than just a venture fund. But it's where many people in our industry need to galvanize.
Yeah. So let's leave on a more hopeful note. A lot of work to be done. What keeps you excited, hopeful, optimistic to keep doing that work?
It's the coolest shit right now. I mean, the people that are making these we see all the decks. There's innovation happening everywhere you look.
Yeah.
From the shoes you're wearing to the air you're breathing to the congestion to the wildfires. 20 or 30 companies are working on each one of those things.
Yeah.
That's amazing.
Yeah.
And by the way, that's only in America, man, that you're going to see that kind of volume of innovation. I do believe that what keeps me excited is that I believe that innovation and technology actually is what this is the only way society moves forward, right? People can be scared of it. There's always articles about the pros and cons, but like AI is going to probably do a lot of great things for this world.
Yeah.
Right.
Yeah.
And of course, we've got to like think about regulations and things. But I think more people got excited this year about AI than the last 10 years combined. And AI has been around.
Mm-hmm.
It's just that they need to see it in their own life.
Mm-hmm.
If we can see climate solutions changing a small town, a fishing town, a lake, just improving a little world, then they're going to get excited and realize this is not political. This is a thing that we need to focus. So I feel like I get excited about that moment happening.
Magic moment, right?
It's a magic moment. So I'm excited about, can we help create more magic moments?
I think what gets me excited, and I'll give you credit here because I think being on the founder calls with you, I have seen founders get better at storytelling. And I think what it's helped me learn is like, this is a skill set you can learn as a founder. This is not something that is like some mystical thing that, Vijay Chattha picked up on a mountain in the Himalayas and only he knows how to do. We've obviously, as a company, had 20 years of experience doing this. And so that obviously counts for something. But as a founder, if you are building something that's a hard engineering problem, that's a hard technical problem, that's a hard science problem, but you take the time and invest the time to learn how to tell your story, to learn what your audience cares about, to learn how to tell the same story in a couple different ways to related audiences. Like the fact that the skill set can be learned means we can bridge the gap between really cool stuff that is happening at the lab stage or at the sort of early product stage and actually take it to customers that are willing to pay for it if only they could understand how it solves their problem.
Yes.
And they don't necessarily care how you're doing it. Maybe it has blockchain, maybe it has something else. They don't give a shit. Does it solve my problem? Can you do it quickly? How fast can you get it here? And if we can help more founders do that, and we've already been doing that with the 17 companies in our portfolio, then that anxiety that I was talking about a little bit earlier, but are we moving fast enough? We can actually make a difference in helping companies move fast enough. And so that's my why. That gets me excited. I'm actually able to help these companies in a meaningful way and, kind of bring it back to where we started the conversations. It's kind of why we're doing this together. It's why we started this.
Thank you for listening to another episode of Climb by VSC. We're available on all major social platforms. If you like what you heard, leave us a 5-star review. If you love what you heard, recommend a guest to us. Thanks for listening. See you next week.